and gentlemen, good day and welcome to Q4 FY2022 earnings conference call of Expleo Solutions Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Asha Gupta from EY LLP Investor Relations. Thank you, and over to you, Ms. Gupta.
Thank you, Margaret. Good morning to all participants in the call. Welcome to the Q4 and full year FY22 earnings call of Expleo Solutions. The results and investor presentations have been already made to you, and they are also available on the company's website. In case anyone does not have copy of press release and presentation, please do write to us and we will be happy to send it to you all. Representing the management today, we have Mr. Ralph Skeleton, Chairman and Non-Executive Director, Mr. Balaji Vishwanathan, Managing Director and CEO, Mr. Desikan Narayanan, Chief Financial Officer. Mr. Balaji will start the call with brief overview of the quarter and year gone by, which will be followed by Mr. Desikan, who will be getting into detailed financials. After that, we will open the floor for Q&A session. As usual, I would like to remind you that anything that is mentioned in this call which gives any outlook for the future or which can be construed as forward-looking statement must be viewed in conjunction with risk and uncertainties that we face. The risks and uncertainties are included but not limited to what we have mentioned in the prospectus filed with SEBI and subsequent annual report, which you can find it on our website. Having said that, I now hand over the call to Mr. Balaji. Over to you, sir.
Thanks, Asha. Thanks, Margaret. Thanks to all the investors and interested parties who are there in this call. Excited to announce our financial year 22 results and also the Q4 results. As I mentioned in the press release as well, we have had a good last 18 to 24 months, and we continue to see good traction from the business side. We have also had a lot of exciting results from a people front and the technology front as well. Signed new partnerships. We have signed more than 20 plus new customers in this financial year. The revenue growth has been robust over the last 6 quarters at least. And we continue to see reasonably good demand. Of course, given the kind of macro situations that we are seeing with the war and the recession and the possible deflation, rate hikes and other stuff, we are still being cautious in terms of what kind of investments we are making. But the situation looks, or the market demand looks quite robust from where we are. We have had reasonably good success with our automation first approach and the consultative approach that we have taken for the digital transformation. And that's what is driving or fueling our growth this particular point of time. We are also glad that we have been able to add 2 new larger customers with more than 1 million revenue and with 2 customers who are with over 5 million revenue. If you recollect last year, we had only 1 customer with more than 5 million and just about 8 to 9 clients with over 1 million revenue. There has been a lot of traction from a people perspective. We had a very good Great Places to Work survey where our people actually rated us at close to 75% acceptance level and more than 85% in terms of Great Places to Work acknowledgement for the kind of response that we have been able to drive during the pandemic and how we have been able to support the team members, considering that they are our primary assets. And we have also focused a lot on employee engagement, diversity programs. I'm happy to tell you that we have actually onboarded a few differently abled people on technical roles and who have been doing reasonably well as well. And we've seen reasonable success on the online upskilling program and also on the technical engagement as well. Compared to last year, we haven't really gone full steam on the graduate hiring program because last year was our first experiment, and this year we are trying to take the learnings from that and making sure that we are making it more broad-based rather than from one location per se. But that's something which we are committed to for this year as well. So that's all I have as an introduction. It's been a reasonably good quarter, a reasonably good financial year, and we hope to continue with this possibility.
Thank you, sir. Should we open the floor for Q&A session?
This is Desika, and I'll give a little brief about what the performance is for the quarter. Good afternoon, everyone, and good to have a good performance during the quarter. It is in line with the market trend with the same set of challenges across the industry. We are also facing the same. We'll walk you through the year-on-year performance and the quarter-on-quarter. The financial year ended with a revenue of 400 crores compared to 300 crores, around an increase of 34%. EBITDA closed at 19.4% compared to 23% the previous year. The revenue majorly came from Asia, which did good during the year. On the cost side, we had regular increase in the cost. Specifically on the third party, we need to invest more on that because of the current scenario of resource need. And also we had cost in training and recruitment, and last but not least, we had some expenses in merger. Those are the major change from last year to this year. Our earning per share increased on 7%, ended at 52.858. On the quarter-on-quarter, the revenue grew by 7% to 113 crores. EBITDA raised from 15.7% to 20%. Reason for EBITDA increase is, of course, revenue increase, plus we had a foreign exchange gain during the quarter of around 18 million compared to a loss of 16 million last quarter. And we also had last quarter, we had some software purchase for the projects and some recruitment training costs. So all put together, we had a better quarter during the better quarter. Profit after tax ended at 15% compared to last quarter of 13%. One update on the merger activity, it is still pending with the NCLT. They have, since the court are in summer vacation, this is something which is little dragging. So we are working with the consultant to make sure that we can get our hearing coming. So that is the current state of things for the NCLT merger. That's it from me, and we can open up for the question and answer. Asha?
Yeah. Margaret, can you please open the floor for Q&A?
Thank you, sir. Should we open now for Q&A session?
Yeah.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shrishti Jain from Monarch Networth Capital. Please go ahead.
Congrats on a brilliant set of numbers, sir. So I actually wanted to understand a little bit on the demand environment. Like, you elaborated in your opening remarks that we are facing some geopolitical issues in our dominant geographies, how do we see the demand environment panning out? And in that same line, how do you see growth for us, the listed as well as the unlisted companies doing, and even for the parent, for the next few quarters also, and for the next couple of years, maybe FY24, FY25?
We are closely monitoring the geopolitical situation, but we don't, at least, based on the war and the political situation, we don't see too much of an impact for us because we don't really have too much of exposure either in the Eastern European or in Russia or Ukraine for that matter. But from an economic situation, we're still trying to see as to how this is going to stand out. The higher inflation rates in UK and in the US, and we are seeing inflation in India as well going up. So we need to still figure out as to how the demand is going to get impacted because of that. But as of now, there are no signs of any slowing down or any kind of impact at this particular point of time, at least for the next 2 to 3 quarters. And what will happen over the next 2 to 3 quarters is what is going to be the indication for the next couple of years as well. So we are closely monitoring the situation, and that is also one of the reasons why the third party or the contractor costs are slightly higher as well for us. So we're trying to meet the demand that is currently there in the market, which is quite robust. And for the group, Ralph, it would be good if you could probably highlight.
Yes. Thank you, Balaji. I can certainly do this. I think overall we are, and I want to confirm this, even we are pleased with the performance of the management team and with the accelerated growth that we have even seen in this business segment here. We even see a good growth momentum across all the different industry segments, across all our regions and geographies, certainly impacted by some of the macro risks from a macro perspective, some of the risks that we are facing, certainly some of the uncertainties, even then with the war in Ukraine. As an organization, as we don't have any operations in the Ukraine, but even then put on hold and terminated business activities, even there with Russian organizations, and especially in the more on the engineering side of our business, still a little bit the uncertain situation with the pandemic in China and an impact even there of the global supply chain. But overall, as the majority of our activities are in the aero, auto, transportation and energy segment, is more in the R&D segments, and what we do in the other industries is even then more in digital transformation. We are still expecting to continue with a good growth momentum, as we can see that all our customers are investing in the change of their own business model, even to implement new business models, and therefore we are even foreseeing quite a good growth momentum over the next couple of quarters, and this is even underpinned, I think, by the performance of the first quarter this year, and that's why we even outlook a little bit more from a group perspective.
Sure, sir. Thank you. Sir, and the second question was on the attrition rate. Where is it currently? And, would we be expecting higher than normal wage hikes in FY23 or CY22? And, what kind of margin levels would we anticipate to negate that impact?
Yeah, the attrition rate continues to be higher. While our target has always been plus 20%, we are currently running at close to 30% in terms of our attrition rate. And the attrition is certainly impacting, but it's not. That's where the objective of trying and getting contractors and the other models in place to make sure that we are not losing the business from a customer perspective. And in terms of wage hikes, I would say that it will probably be still around the same as what we had last year, anywhere between 14 to 15% overall wage hikes is what it's likely to be, and as usual, the lower levels will have significant 25 to 35%, and the higher levels will probably see a slightly lower increase. But the overall is going to be simply similar to what it was last year. We don't really see this impacting the EBITDA levels significantly, because we are trying to control our other costs, including we had given up one of our sites and moved to Coimbatore and at a slightly cheaper rate. So we're trying to look at all the other costs and how we'll optimize. But at the gross margin level, we may probably see a 1 or 2 percentage drop because of that. At the EBITDA level, we'll continue to be focusing on that anywhere between 17 to 18%.
Thank you, sir. I'll join back in the queue.
Thanks.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Aman Vij from Astute Investment Management. Please go ahead.
Yeah, good morning, team. My first set of questions are on the unlisted entity. If you can talk about the unaudited numbers like we have been talking for both Pune as well as the Bangalore entity.
The one thing I can say, the things is unaudited, you mentioned, we want to make sure that it is audited and we can publish it. That's the current thing. I can tell you one thing on the overall. If I look at the other unlisted entity, they are on the revenue side, they are doing better than what we expected. And the only thing is that little bit of on the EBITDA side, they will be coming lower than what we projected for. But again, that's again in line with what we are also facing. That I can tell you as a current update about the unlisted company. Once it is audited, then it will be easy, because when we do the shareholders meeting, we will be sending a notice in which we will be publishing the data in there. It will be an audited data, and that will be more in line with what is.
If you can talk about, was the revenue growth more than the listed entity, or was it less than the listed entity?
Both combined together, the unlisted entities, it will be less than the listed entity. We are expecting about 300 crores. That's the way we are looking at it.
Sure, sir.
It's been in the range of around 25 to 28% is what the growth rate is, while the listed entity growth rate is around 35%.
Sure, sir. That helps. On the employee count, so if you can talk about what the current number is, and also if you can divide among the 3 entities. And just wanted some clarification. So the number we have mentioned in the presentation is around 1,700, but my understanding is the number should be around 2,100. So is the 400 people still on bench, not currently in project? So if you can talk about these 2 things, the current employee number across the 3 entities, if you can segregate, and why the difference between 1,700 and 2,100 or more.
See, the 1,700 is only generally we put only the delivery folks, not including the subcontractors. So that if you put together, it will be around 2,000 is the number what we have in the listed entity. It's only employees and the 2 in delivery. So we don't have the third-party consultant added in that.
So the number mentioned in the last call was 4,000, 2,100 in the Chennai, and then 900 in Pune, and 1,100 in Bangalore. If you can give the updated number for Q4.
Yeah, we have around 4,600 people in total, and close out of that, the billed or apart from the support headcount, it will probably be around 4,300. And the split is somewhat similar, close to 2,000 employees in 1950 or so in Chennai, and a little over 1,000 in the Bangalore engineering piece, and close to 1,000 in Pune as well.
And the additions, sir, we are targeting for this year?
We should be having a net addition of at least 400 to 500 people.
Sorry, you mentioned 100 to 500 people?
Sorry, what is 100 to 500?
Sorry, what numbers are you mentioning?
No, 400 to 500. 400 to 500. Sorry, my voice was not clear. It's 400 to 500.
Okay. Because earlier, if I remember correctly, we were targeting like 1,000 employees addition. So, any reason for this little lower guidance?
No, that includes the trainees as well. The 1,000 employees that we were targeting was including the trainees as well. So, on the trainee headcount, not all of them would be billable right from day one.
Okay, but if we talk about like-to-like number, we are still maintaining that 1,000 employees. Yeah. And if you can talk about the quarter-on-quarter growth we are expecting for next 2-3 quarters, is it still 7-8%, or should we expect little lower given little headwinds in the economy?
We don't see any reason why it should be lower than where it is right now, but it should be anywhere between that 6 to 7% is what our expectation is. But of course, quarter on quarter, we are closely monitoring what the demand situation is.
Sure, sir. I have more questions. I'll come back in the queue.
Thank you. We would request participants to please limit your question to 2 at a time. The next question is from the line of Vinayak Mohta from Stallion Asset. Please go ahead.
Yeah. Hi. Good morning, everyone. Congrats on a very good set of numbers. I broadly had a question regarding, the combined entity. So, if I remember, so right now you are broadly at a run rate of 700 crores. So at a 20-25% growth rate, you would, broadly be doing a 1,000 crore revenue by FY24. And a PAT of broadly 130 to 150 crores. Is that a fair assumption to have given the order wins or the demand environment that you've been witnessing, considering the situation that, things might be a little bumpy in the near to mid-term, given the situation overall?
Yeah, that's our target as well. Our objective is that we should cross the 1,000 crore mark within the next financial year.
Next, as in FY24, right?
That's right.
Yeah. Okay. So my second question would be, I just wanted to understand, how would the ER&D grow out here? Because broadly, if I remember correctly, it's at a 150 crore run rate or something. So and what would be the blended, how do you see the margin trajectory going forward? Because ER&D automatically is a higher margin business. So how would the margins move in the next 1 to 2 years? Because right now we're at 17-18% as you have guided for. So just wanted to understand that trajectory and the growth in that business over the long term. Where do you see, as a business mix be standing at?
So the unlisted company saw a good growth in the ER&D business in the last financial year, close to around 45 to 50%, and all the other businesses put together was in that range of around 25 to 28% is what the unlisted company's growth rate was in terms of revenue. The challenge in terms of talent is actually even more higher in that segment of the business. So that's obviously impacting the margins as well. What we used to consider as a high margin business also comes with a higher cost on it. So the margins are still around the same as what the traditional tech business is as of now at least. And we think, while the demand was quite robust, right now, we are also looking at how it's going to span out, particularly in the manufacturing industry and then the automobile industry over the near term, because there is more demand on the digital side, even in the ER&D business as well. So we expect that it will continue to grow at that 25% year on year. But the margins are likely to be around the same as what our normal tech services businesses, at least in the near term. But in the longer term, it should certainly get better.
Understood. Is there here 25% right, or did you say a higher number?
25, yeah.
25. Okay, understood. Okay, thank you so much.
Thank you. The next question is from the line of VP Rajesh from Banyan Capital. Please go ahead.
Hi, thanks for the opportunity and congratulations. This is one question on the numbers, audited numbers for the unlisted companies. When do you think they will be available, and does it hinges on getting the approval from NCLT, or it is a separate process?
Sorry, Rajesh, I could not hear it. You were talking about NCLT approval you were talking about? Or?
No, I'm asking about the audited numbers for the unlisted entities. By when will they be available? And is it related to the NCLT process, or is it separately that you can actually share that number with the investors?
Technically, we don't need to, is my view, that we don't need to share the numbers of the unlisted company. But once the audit is over and it goes to the ROC, generally we file the ROC, then it will be more a public thing. But prior to that, we expect that once the shareholders meeting is approval is given by NCLT, we will be, the notice will have the unlisted numbers financial. So that way, we are expecting something somewhere around the time frame to publish it.
So Rajesh, the NCLT and the audited results don't have anything to do with each other. Audit is going on right now, and the audited results should be available sometime in June, because there isn't really any time pressure like the listed companies to complete the audit. And that will anyway be filed with ROC as per the normal process. And depending upon how soon we get the NCLT approval, it will be included in the shareholders meeting notification as well.
Understood. That's helpful. And basically, you mentioned that there were major costs in this year. So can you quantify that number, please?
Which cost? Sorry, Rajesh, the telephone line is little low. Which cost you said?
Merger-related costs. You mentioned there were merger-related costs which were there in this financial year.
Yeah. That's relating to the professional fees what we pay for the consultant who involved the banker and the auditor and the legal fees. Those are the costs which I was mentioning about during the year.
Right. I was just asking what is the number? What was the total number for the year?
Around around 41 million INR.
41 million INR. Okay. And do you expect more costs like this to accrue in fiscal year 23, or majority of this is done in the last financial year?
Majority is done in the last financial year. We will have some cost, only some incremental costs will be coming, not much. The one thing will be there will be some stamp duty which will come, which may be coming once we do the merger. That's the time the stamp cost will be coming. That is one major cost will be coming.
Okay. And then my last question is just about the dividend. So we had talked about coming up with a policy, etc. So any update on that side will be helpful.
Yeah, so we have published a dividend policy, Rajesh, and we are looking at, like what I mentioned in the last couple of calls as well. We're looking at how do we utilize the cash. We did this small acquisition recently, and there is one more which is likely to come up as well. But between now and the quarter one AGM, we will decide on what's the quantum and how we are going to distribute cash as well.
Okay, wonderful. Thank you so much, and all the best.
Thanks, Rajesh.
Thank you. The next question is from the line of Rahul Picha from Multi-Act. Please go ahead.
Hello. Yeah, thank you for taking my question. Sir, I wanted to understand that right now roughly more than around 45% of our revenue comes from the Asia region. So just wanted to understand our currency exposures in that market. So are our billings done in USD or is it like in some other currency?
Asia, you're talking about Asia, right? Sorry, brother.
Yes.
No, go ahead, Jessica.
If it Asia is majorly Middle East, Singapore and India. Not much. One thing is that if you look at, we do bill in dollars for Middle East, and majorly it will be dollar in the Middle East, and India it is INR. So that way we do have EFC accounts where we have the dollar what we receive from the client. And if you look at the way we are maintaining our bank accounts, whatever the proceeds come from the client, we keep it in the EFC account and try to pay all the expenses related to the respective currency in that currency, so that we don't have any forex impact. So something the local expenses what comes in is paid in that currency itself. So that way the exposure is minimum. And with respect to, since the US dollar is weakening against INR, I see only a positive trend coming in this Asia market.
Okay.
India INR, so there is no exchange risk.
Yeah. And sir, my second question was on the acquisition that we did. So can you just speak about that? Like what capabilities have we got through that, and what is the purchase consideration that we have paid for it, and any quantification of revenues that entity might have?
So Lucid Tech Solutions which we acquired are specialists in data governance and analytics. They are partners with the leading data governance platform.
Sorry to interrupt you, Mr. Vishwanathan. We cannot hear you very clearly, sir.
Okay, is it better now?
Yes. I would request you to repeat your response, please.
Sorry, yeah. Lucid Tech Solutions that we acquired are actually specialists in data governance and analytics, and their primary business is actually in the US. So they last year they did a revenue of close to $3 million, and this year they are likely to do close to around 3.2 to 3.5 is what our expectation is. And this will actually give us a really good hold on our own data practice as well, because we have been focusing on healthcare, banking, and other industries on how we could support the implementation, testing, and the application integrations or the API integrations, particularly from a data perspective, and that's what this is going to give as a capability for us. We're already seeing some traction with our existing customers as well. And the partnership of Lucid Tech with the global platform also gives us an opportunity to cross-sell our services to some of these large customers as well. That's the basis with which we went ahead with this transaction. Jessica, you want to add anything more?
I think that's one of the things which we majorly bought is that the IP and the know-how what they have. Which they are selling it as a license to the clients. That will be our entry point for any new clients, and that's the way they have been doing their business. So that will have good amount of clientele which will be coming in. So those are the things which we feel that will have an added capability for us from Lucid.
I think as it was mentioned by Balaji, I think when you look at the R&D initiatives, when you look at the transformation initiatives in our target markets, I think it is always a domain-specific part, but the two most significant enablers are always data and security, and therefore it was even important for us even to make an investment into these data-led capabilities.
Okay. Thanks for the clarification. Sir, just if you can specify the purchase consideration for this acquisition?
So the purchase consideration consists of payments based on what their current revenue is and the future revenue is. So we have the payout considerations run for at least another 15 more months, and it's to the tune of one time of the revenue at this particular point of time, around $3 to $3.2 million.
Okay, thank you. And sir, my last question is on the salary hikes. Like in the past, we have stated that normally our hikes happen in the month of January. So have we taken any hikes in the last quarter?
Yes, we have.
Okay, and can you quantify how much that would be?
It's more from a market trend, because that's something which we make sure that it is in line with the benchmarking and how the market is. Technically, if you ask me, it is in line with the market trend with the one what we have done.
Okay, thank you.
Thank you. The next question is from the line of Tushar from Ratnabali Securities. Please go ahead.
Yeah. Hi, good morning. So my first question is regarding COVID is receding now and the traveling is opening back up. So can you just explain how our margins can be affected in the near future? And my second question is regarding our employee workforce. So the data that I have shows that our employee base has almost doubled in the last 18 months. So could you please explain whether this is based on anticipatory demand and what kind of pressure can it have on our margins going forward?
I didn't get your first question. What was the first question?
Right now, as other IT companies are also saying that traveling is opening back up. So travel expenses which were being saved in the last 2 financial years, that should start coming back on our PL, right? So can you just give an estimate on how our future quarters might be showing in terms of other expenses?
It is likely to open up, but it's not that it's going to go back to what it used to be in 2019 or the first quarter of 2020. We don't see the travel expenses impacting our margins at least in this quarter or next quarter. It's not going to be that significant at this particular point of time. If you had seen, because the travel is opening up, some of the on-site deployments are also increasing, and so our on-site contribution of revenue has gone up from 32% to 36% in this quarter. In terms of margin impact, I don't see anything which is happening at least in the next couple of quarters. We'll keep a close watch on our selling expenses, which is what is primarily going to be driven by this particular travel. And on the employee count, we've almost doubled in the last 18 months, and out of which close to around 350 to 400 are through the trainee route, and out of which significant number of people have already been deployed in some projects or other. And we don't, it was in anticipation of both future demand and also the attrition that was picking up at that particular point of time. And we will do something similar, but may not be to the same quantum during the course of this year. But we are trying to do it across all the entities rather than doing it only with the listed entity. The margins I had mentioned earlier as well, our expectation is that we will continue to be in the EBITDA range of around 17 to 18%. And we don't see any reason why we should think of anything lesser than that at this particular point of time. So it's not a guidance, but we don't see any reason why we should think of anything less than that right now.
Thank you. We request Tushar to rejoin the queue for follow-up questions. Request participants to limit your question to 2 at a time. The next question is from the line of Rohit Balakrishnan from iThought PMS. Please go ahead.
Yeah. Hi, Balaji. Congratulations on good numbers. Hi. Balaji, most of the questions have been answered. I could not hear a couple of things properly. So first was on just the bookkeeping numbers. On the unlisted entity, you said that we have crossed 700 crores. I could not hear that number. So if you could just... Okay. And what would be the cash at consolidated level today? In listed plus unlisted?
Listed, I can say it's around 155 crores.
Correct.
Unlisted, I need to get you. I don't have it right in front of me.
Okay. I remember it was close to 300 crores at the time of an announced merger. So, okay, sure. I'll probably get in touch with you to get that number separately. In terms of outlook, Balaji, for FY23, on the listed entity, you mentioned that we still can see 6-7% kind of quarter-on-quarter growth that you had alluded to in the past. What about the unlisted entities? Are we seeing similar kind of growth there? And what is the kind of outlook that you are looking at? Because I remember in one of the calls you mentioned that probably the unlisted entities can grow much faster given the plans of the group and the overall offshoring goals that we have as a group. So if you can just shed some light there.
So probably, Balaji, let me answer this question, and I certainly do appreciate all the interest and in all the other business segments that we even have. There is, from today's perspective, no reason why even the other business segments should even have a lower growth rate than what we have even here in scope of this call and the discussion and the numbers that are in front of you. It is certainly supported even then by the growth in the, from our perspective, so-called engineering segments, air, auto and transportation. Even then supported even by a strong shift even into our centers and our activities in India. So I can certainly confirm that we don't see any indicators why even the other business segments should grow at a lower pace than the numbers that you have in front of you here.
Wonderful. That's great to hear. And Balaji, one question on this, on the list scope that we have. We've added a lot of clients and also increased the $1 million and $5 million client count. Can you just share, you've been sharing in the past as well, but just maybe a bit more on what is really driving this growth? We have been really growing very well and we continue to be very excited about it. So, is this largely driven by our own outreach in terms of organically finding clients versus support from the group? I'm talking only about the listed entity at this point of time.
Yeah, it has all been primarily around the sales effort and the account management effort. Both with existing customers and with the new customers. And, like what I mentioned in the last 3-4 quarters as well, our objective is to try and look at where the opportunity is and try and grab this opportunity, even if it means, we have to stretch or we have to make an investment, and that's what is actually driving most of, the growth at this particular point of time. And it started showing results over the last 4-5 quarters, and we hope that it will continue to be in the same trend.
And just one last question before I join back with you was this acquisition that you did. You mentioned it was. Did you mention how much did you pay for it? I sort of missed that.
So the total consideration, between the IP, the assets, the people, and the businesses that they were transferring was, around little over their 1 year revenue. Which is around 3.2 million, but that's to be paid over a period of 18 months.
Got it. So we've not yet paid it out, but it's about $3.5 million, roughly.
That's it. That's correct.
Okay, got it. All the very best, Balaji and the team. Thank you so much for answering my questions.
Thanks, sir.
Thank you.
Thank you.
The next question is from the line of Ashish Dash from Sharekhan by BNP Paribas. Please go ahead.
Hi, sir. Thanks for giving me opportunity. I'll again ask you on the cost side. So employee cost has increased. That is one reason you mentioned that wage hike. Is there any other thing is involved in that increase of employee cost? That is one. Second question on cost side is the other expenses as percentage of revenue declined substantially, and I know there is absence of software purchase consideration, but will it sustain, this level will sustain in FY23, this other expenses to revenue, total revenue, and our exit margin is strong. Why we are guiding 17 to 18%? What is the major headwinds you see in FY23?
Just one, because the first one I could not hear it properly. Can you repeat the first question you asked for?
Employee cost. I asked for the employee cost. It is increased 12% around quarter on quarter. One is due to the high wage hike. So what are other components are there for the increase in the employee cost? Is there any other thing? Yeah.
Not much. It's majorly it is one is the increment, and also the number of people increase from last quarter to this quarter also has contributed to that increase. Other than that, I don't see any big increase. With respect to the other costs, last quarter we had some cost which is not there in this quarter. But looking at the trend of the cost, there are certain costs which comes in. If you look at the retention of employee training and other activities which we do, these are the things which may have an impact on the overall margin. So that is very difficult to kind of predict in the current market. If you look at our subcontract costs from last year to this year, a substantial increase because the market demand is completely changed. Now, if you look at the current market requirement, is that we need to look at how to retain people and also do the recruitment. So these things are aspects which we can't define a certain cost as a cost which will be there. So this gets on fluctuating. So that's the reason we must not give a guidance, but just we are looking at a trend and saying that it will be in the range of the EBITDA will be in the range of 17 to 19%. So that's the only thing. Other than that, even the current the major cost is that it's an employee cost. That having a little bit of fluctuation due to the market change, that is something which we are putting it in there in our what we see as a trend in the future.
Okay, got it. My second question is on your guidance. Earlier you have given the guidance of EBITDA margin for the combined entity would remain in the 15 to 17% post the merger. Now your listed entity has done better than your aspiration of 18% in FY22, and now you're saying that your unlisted entity has some impact on the EBITDA margin. So would you like to maintain that guidance, or what is the outlook on your margin guidance for the combined entity?
Technically, that is not a guidance because we are not supposed to. We are just more talking about probable kind of number and expectation.
We don't expect any big change in that. It continue to be the same. It's not a guidance like what basically said. We don't really give any guidance, but that's what our expectations are.
Okay, your aspiration. This last question: any large deals you have won during this quarter? Because you mentioned that there are some large deals in Q3 and Q4. So, any large deals you have won or anything in the pipeline?
So we don't really discuss our client list because there are confidentiality reasons. But yeah, we haven't really won anything in the last quarter. But last year, of course, we won two major customers, $1 million plus and one which was a $5 million plus. And we have a couple of them in the pipeline as well. But normally we don't really discuss our client list.
Okay. Thank you so much for answering. Thank you.
Thanks, Ashish. Thank you so much.
Thank you. The next question is from the line of Deepan Shankar from Trustline PMS. Please go ahead.
Good morning, everyone, and thanks a lot for the opportunity. So firstly, can you throw some light on these two new customers added during this quarter?
I think you are asking about two customers above 5 million. What one is asking?
So major customers added during the quarter is two, right? So
during the year, we're going to expect during the year two customers with one with more than 5 million and one with more than 1 million was added during the year, not during this quarter.
Okay.
We had actually covered the 5 million plus customers in the past as well. It's one of our tech companies, and it's a global client whom we are servicing across multiple geographies as well. And that account continues to grow with the kind of capabilities and the services that we are offering at this particular point.
Okay. And what is the reason specifically for this digital slowing down Q1Q to 4% growth versus company growth of 7% Q1Q?
So the digital is not much drop. It is more from it's actually increased, but the percentage, if you look at it, it's very small, from 38.6% to 37.7%. We are talking about a 1% fluctuation in the quarter to quarter. But on value wise, it has increased. So we don't see anything dropping there.
Yeah, but the trend is not reversing, right? So that's what we wanted to make it clear.
Generally, for the digital, if you look at it, the trend has been raised from 26% to now we are in 38% range. So we see that we'll kind of maintain in this quarter and also will have a increase. The ultimate
the trend is not reversing in the numbers. It is likely to only go northwards. I don't see any reason why the trend should reverse because the demand is still there in the market.
Okay. And lastly, what is the kind of direct contribution from the group for full year?
That's in the range of 20% of the. But again, a little bit of the direct contribution from the group. See, what I'm mentioning here is that the clients which we have, the group as a client is around the revenue is around 20%. But contribution as such is more than 45% because there are regions where the group is intending the client and we also signed with them directly. So that way we have support coming from the group for all the European clients. So that all put together, it will be in the range of around 45 to 50%.
Okay. Thank you, Anand.
Thank you. The next question is from the line of Hiten Jain from Invesco. Please go ahead.
Yeah, hi. So I have a few questions. So first is when we look at your revenue growth trajectory, just looking at fourth quarter of last financial year, fourth quarter FY21, first quarter of this financial year, second quarter of this financial year, you were reporting a 10% sequential growth. Now you come down to 6 to 7% kind of a growth. And even when we look at headcount CAGR, so obviously in 2 years you've kind of doubled, but your revenue CAGR is lagging your headcount growth, and even quarterly outcomes we are seeing this slow down from 10% to 6 to 7%. So what is exactly happening here, and is this that 10% was unsustainable, 6 to 7% is so that's a slowdown from what you've been doing, but your headcount growth was quite strong. But in fact, in this quarter, your headcount is also just 2% up QOQ. So is there a slowdown from if you look at quarterly trends?
No, there is no slowdown. See, the thing is that when you look at it last 4 quarters back, the base was lower as well. If you look at the quantum of growth, it has always been more than that. So, 10% Q on Q between Q4 of 2020 to the Q1 of 2021 If you look at the quantum, it's probably higher now. But since the base is higher, obviously the percentage is showing lower. So we don't see any slowdown at all. And obviously when the base becomes bigger, then the growth percentage also is likely to be in that range. From the employee count versus revenue, we had mentioned this last time as well. The reason is that we had actually hired close to around 350 to 400 trainees last year in anticipation of growth, and which is what you will see those utilization of those resources and driving revenue over the next few quarters as those trainees become billable and they start generating revenue as well. There was an anticipation, and that was an investment that was made primarily because we found that anyway our other costs are not in the same line as what it used to be earlier during COVID times, and we thought that we use that money to make sure that we are investing for our future. So there is really no reversing of trend or slowing down of any of those trends.
And okay, and this group business from group, so last year also it was 21% of your total revenue from group direct, and this year also you've spelled out that number as 20%. And then you talk about this indirect exposure where group facilitates business in Europe. But Europe is your slowest growing geography today. It just grew 19%. Even if I look at mix of Europe, it was, in fact, 2 years back it was 59% of revenue. Today it is 51% of revenue. So shouldn't this group be driving a higher traction in your business?
It is one, because when the biggest thing is that when all the other markets are growing at 35%, even to sustain at the same percentage, the group also has to grow at the 35%. So that's what has happened, in the last year as well. So despite being a slow growth market last year, but right now Europe is actually seeing phenomenal amount of demand. May not be the, if you look at UK, Ireland, Germany, the demand is certainly picking up significantly. And so if you want to look at where we are growing at the 35%, in a slow growth market itself is significant. Ralph, you want to add anything more?
I think when you even look at the relative performance, I think we are even then hitting the base as you have described and confirmed it. On the other hand side, we see across the European markets definitely a good growth momentum that we even see there, not only in the financial service and the insurance and banking industry, but even in other segments. Still even now quite a tendency even to keep activities within the European Union. This is even something that should not be underestimated when we even look at our growth trajectory, and therefore we are happy even that we can even continue with the same contribution to the growth that we can see in this entity here.
Yeah, Balaji, but even this year, it just grew 19% year on year, Europe versus 34% for the total company.
Yeah, that is because other geographies are growing faster. I don't see any reason why 19% is certainly a reasonably good number of percentage of total government.
But Bobby, let me try to clarify it again. We see the same growth rates when you look at it from a European perspective, but all the growth in Europe is even then translated even in the same way, even then into the growth even of this entity. As I said, we are even then see that we see the significant growth even in our centers that we even have within the European Union in Eastern Europe, and this is even where even then these centers are even contributing to our growth strategy. So not all the growth that we are generating, and there is no one-to-one correlation between the growth rate that we see in Europe and the increase of business activities for this entity.
Sure. And another clarification, I just wanted to understand when I look at your numbers. So the number of active customers has gone up from 68 to 100 year on year. But whereas your 1 to 6 million is up just 10 to 11. And on the other hand, the 500,000 to 1 million is down from 17 to 16. So does this data tell that perhaps your client mining is not very active as compared to client hunting?
No, it's not actually. Once again, you look at any benchmarks, the instruments that we track on is what is the revenue that's coming from existing customers and what's the revenue that's coming from new customers. If you look at what our trend has been in the past, we have been in the range of around 5% from new customers, and that's the trend that we wanted to get to at least 10%, which is what we have been able to do this year. So it's not that the focus is not on existing customers. Otherwise, you can't make a 5 million customers in 1 year. So that's the reason why you have 5 million customers who have been mined and grown as well. So there is a special focus on what the strategic accounts are and where we are growing.
Sir, your voice is not clear. Sorry, your voice is not clear.
Sorry. So there is a focus on both, and our objective was that we wanted to reverse the trend of new account growth from new account revenue from trend of around 4-5% a couple of years back to at least 10%, which is something which we have been able to achieve this year. And also in terms of how the top customers' contribution are and how we are able to spread it. So the 9 customers of more than 1 million last year to 11 this year was actually an indication of how we have been able to mine the accounts and grow. Well, having said that, you're saying that have we done everything right? May not be, and that's the focus on how we can get everything going for us with our existing customers as well.
So your top 5 customers last 2 quarters has been very weak. In fact, this quarter your top 5 customers is down 8% QOQ. Last quarter they were up just 3% QOQ. So is there some slowdown in your top 5 clients? And would it be fair to assume that the group is one of those top 5 clients, or you don't, or how do you account for that?
No, we don't account for group as a in those client lists.
Okay.
And some of these could be seasonal, but we don't see any slowing down with any of our customers. And whatever we set as our target for the year, we are actually in line with that, and we are trending in the right direction with all our customers at this particular point.
Thank you. We'll take one last question, which is from the line of Anuj Sharma from M3 Investment. Please go ahead.
Yeah, thank you, and congratulations, Balaji and team, for a good set of numbers. I had one question on the group. So the group has done some acquisition. One is A-Systems Care. So what implications would it have on our Indian operations, both the listed and the unlisted? And generally, what will be the strategy in terms of group's acquisition and our benefits through it? Thank you.
So yes, we had the acquisition of Assistant Care. Even this business, life science business, even then became part of our business activities and our portfolio at the beginning of the year. We see that we, with this acquisition, continue to diversify even our engineering activities, in addition to transportation, automotive, and aero. So that we will there continue on the one hand side with the current portfolio, and we will even bring our technology portfolio that is even represented by these Indian entities here closer to the life science clients. And it is not only then the acquisition that we have made with Assistant Care or in the life science business. We even see that with the acquisition that we have done with ESL with this data governance organization, we will see that we continue to generate synergies between all the different capabilities that we had in our portfolio. As we even see a significant part of the life science business will be data driven going forward.
All right. And just one small extension on that. So how long would you think it will take for the acquisition and the synergies to flow to the Indian entities or the Indian group? Thank you so much.
At the moment, we are integrating this life science business with yesterday business activities in France and in Switzerland and in Belgium. So first wave is definitely even in the first half this year to integrate it with our French business. And then from the second half, we will even then see how we can even bring the portfolio, our existing Expleo portfolio, to the life science customers. And then from 2023, we will even then see on how we even then explore new opportunities in the market. And with these 3 waves that we have defined there, or between 6 and 9 months, we will even see then the synergies probably more in 2023, but we will already start to see them probably in the last quarter of this year.
All right. Thank you so much for that.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Thanks, Margaret. Thank you so much for all the questions. It was quite interesting, and thanks for all your interest shown in us and our results. I'm looking forward to seeing you all in the next investor call, or before that, hopefully if we get the NCLT clearance, in the call for the merger discussion as well. Thank you so much once again, and stay safe. Take care.
Thank you. Bye-bye.
Thank you. On behalf of Expleo Solutions Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.